Hi everyone, I'm David Williamson and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. Let's get right to who's winning and who's losing today. And the biggest winner on Friday is BioDelivery Sciences. It's its first mention on Market Checkup and it comes from its shares popping 36% after a successful phase 3 trial for a pain pill it has been developing. Now, it will potentially treat those with moderate to severe pain who are on opiates 24/7. This event triggers a $10 million milestone payment and has BioDelivery in line for another $80 million from its partner Endo Health. Now, the success of this drug has already started buyout speculation, so BioDelivery is one to watch, especially as it releases data from a second phase 3 trial later in 2014. So moving on to who's losing, we're going to go with BristolMyers Squibb. Okay, it isn't actually the biggest loser in percentage terms today, but no one lost as much market value as BristolMyers Squibb after reporting what was generally considered a great fourth quarter. Revenue and earnings both beat estimates soundly at $4.4 billion and 51 cents per share. Sales of key drugs like Sustiva and Yervoy had nice gains, along with Plavix, although Plavix sales did benefit from a one-time boost thanks to some California Medicaid rebate adjustments. The problem, however, was the lack of a decision to move its immuno-oncology drug nivolumab forward in a very clear manner. This drug has been the real driver of value for Bristol Myers in the past year or so. And so the decision how to move it into late-stage trials in lung cancer, especially in combination with Bristol's already approved drug, Yervoy. The value of nivolumab isn't just its own efficacy, but how it could be the central pillar of a drug cocktail for metastatic cancer patients. The specific trial in question, they're all called Checkmate, but the one in question is Checkmate 12. The decisions are complicated given the amount of combinations that Nivo is being paired up with, including Tarceva, Avastin, and traditional chemotherapy. Data is expected at the ASCO conference in June, so it looks like we're going to have to wait until the summer to get more color on nivolumab and potentially its competitors, including Merck's 3475. Which Merck is aggressively pushing towards approval as well. So stay tuned on that, but not a good day, unfortunately, for Bristol Myers Squibb investors. And moving on to our headline segment, we're going to keep talking earnings as Intuitive Surgical has reported. I said yesterday that I was watching Intuitive's earnings to give some clarity, and now that they're out, we actually have very little extra clarity. The company declined to give concrete 2014 guidance and stated that they couldn't because of the changing industry dynamics, including the impact of Obamacare. Shares are down 6% on the news, but they are still trading above where they were when Intuitive previewed its top-line numbers last week at the JP Morgan Healthcare Conference. Even without specific guidance, we did get a bit of a window into what management was thinking. Unfortunately, investors can expect less system sales than we saw in 2013, and procedure growth is going to be in the 9 to 12% range, down from what we saw in 2013 as well. And that's going to be a critical point, and I'll get back to that later. Operating expenses are expected to trend up as the company focuses on international growth via Japan and Europe. And that was a nice boost to the company this past quarter, and also readying next-gen systems and applications. These results may not play out this year, though, so 2014 could be challenging for the stock, especially the front half of 2014. The key will be how well Intuitive Surgical can increase the overall addressable market for the Da Vinci device. And the general surgery growth is nice to see. It's now the second largest procedure for the company. And if just overall procedure growth can head the other direction and re-accelerate, I think Intuitive's management is going about it the right way, prepping next-gen products and focusing on outside the U.S. markets. But as I said, it could be tough sledding for the next at least 6 months or so, possibly all of 2014. At this price, Intuitive is definitely a little more interesting than it was when it was up over 500. Some of the shine has come off the stock, but investors also need to be cautious as well and make sure that they understand all the dynamics if they're buying intuitive now. All right, so moving on to our game segment. For today's game, we'll be answering viewer questions, and both questions have a decidedly Ariad flavor. And why not? Shares of Ariad are up 25% Friday after being up 12% Thursday. The gains have come from a rumor that Big Pharma's Eli Lilly and GlaxoSmithKline have an interest in buying the biotech now that its leukemia drug Iclusig is back on the market, and shares are still 50% lower than where they were sitting before these safety issues were known. In a recent video, I discussed the takeover rumors, and that got the discussion going. Our first question comes from Jared Jewett, who asks, "Thank you for the video, but just a quick question. Iclusig cleared by the FDA for sale once again. You say will only be used as a last resort. So call me crazy, but the drug is for leukemia. I think it is all a last resort at that time." And Jared, great question. Given the seriousness of the disease, I understand your sentiment. And in a vacuum, given Iclusig's effectiveness, its potential fatal side effect issues are no worse than the leukemia it's treating. However, it is in a vacuum, and there are other drugs, including Novartis's Gleevec and Tasigna. These will be the ones leukemia patients try first, and this is where the real sales potential of Iclusig lay and why the stock cratered from a $4 billion valuation. Patients can only get Iclusig after failing these other drugs. That's what I meant by last resort. And by nature, these will be patients with further disease progression and will spend less time on the drugs. Now, there is a small subset of patients with a certain mutation who can get Iclusig now, but the overall sales estimates of this drug are much smaller than it could have gotten to the front of the line and competed directly with Gleevec and Tasigna. Now, Ariad has one other drug in its pipeline, a lung cancer drug codenamed AP26113. I mentioned that if a pharma were interested in this drug, it could license it out. That caught the attention of Mikey Chenster, who asked, do supergiant companies actually license from little itty bitty companies? And my answer, Mikey, is yes, they do, quite frequently, in fact. It's a less risky way to develop drugs if you're a big pharma. The big pharmas can wait until a drug usually gets through mid-stage development, right about where OL-113 is sitting now, and then cut a deal with a spec pharma or biotech for that drug. Now, deals generally include upfront payments in the hundreds of millions of dollars, approval-based milestones also in the hundreds of millions, and double-digit royalties on sales. In return, the big pharma will pay all development and marketing expenses. A recent example would be Johnson & Johnson paying Pharmacyclics $1 billion for the rights to ibrutinib, a blood cancer drug. But I will say that that deal was on the very high side of things. Usually it doesn't hit the $1 billion mark, and ibrutinib is expected to be a huge multi-billion-dollar blockbuster. That deal's worked out well for both companies. Johnson & Johnson has a stock that a lot of investors are, or a drug a lot of investors are excited about, and Pharmacyclics stock has done nothing but go up and to the right during that time. All right, so moving on to watch list, what I'm watching, and I think all investors need to be watching in the healthcare space, the Affordable Care Act enrollment numbers. So far through January, about 800,000 people have signed up through private Obamacare plans. This isn't Medicaid. That pushes the total enrollment numbers close to 3 million. Estimates, because the month obviously isn't over yet, it will put it probably about 3.2 million for the month, which has definitely kept up the momentum from December, where we saw in total 2.2 million from October through December. So there's no lull, although we are still underneath original expectations from CMS, which wanted to see about 4.5 million people sign up at this point at the end of January. So it will be very likely at least 1 million people below that, but that's what happens when you have a non-functioning website for over a month. Now, higher enrollment will benefit the insurers, especially those who have a large footprint on the exchange, and WellPoint is the first one that comes to mind. They've been very vocal about trying to capture a lot of the customers on the Obamacare exchanges. We have seen some concerns on patient mix overall. Aetna's CEO has been very vocal about not seeing the patients or the customers that they would like, but we will see if the younger customers are just waiting to sign up and procrastinating, and there will be a rush at the end of March. This is also a positive not only for the big insurers, but for hospital stocks as well, as the more insured patients that go through their doors will help alleviate their bad debt expense because they will get paid for the services they render. And plus, people with coverage are more likely to seek medical treatment, which means they're more likely to go to a hospital to get treated. So we'll see how well the exchanges are going to their goal of 7 million. I still think that's probably going to be on the high side. I think something in that 5 to 6 million range is more likely given the delays at the beginning of the enrollment period. But fans of the Affordable Care Act and its exchanges should be pretty pleased with the way January is shaping up. Thanks for watching Market Checkup. Stay tuned to Fool.com for all your healthcare news, and Fool on.